Hey, Bulls and Bears, we're back. We're back with another dose of economic reality, as always. And I apologize, it's been maybe 3 days since I put out a video. So we're going to make this report a little bit of an extended one today and try to get all the information that came out in the past few days put out there for all of you. Some of the news you may have heard, but we're going to get into the deeper aspects of a lot of the news that you hear in other places and give you a broad view of the economy and tell you what's keeping this economy going right now. I think most of you know, and even if you know, I think you're going to be really surprised at the visuals and the charts I was able to pull up today explaining everything perfectly as to why people are still spending money, even though the debt levels are in the stratosphere, record levels like we've never seen amongst consumers, amongst governments, states, etc. So it's a mystery to a lot of people, but when you look at the information and charts we have today, you're going to perfectly understand where we're at, where we're going in this economy, and what we need to do to get ready to prepare. So make sure you're subscribed, and let's go ahead and get right into it. Right. So first of all, we're in the biggest debt bubble of all time. The economic, quote unquote, economic growth that we've seen over the past 10 to 14 years, going all the way back to the financial crisis. Let's say we came out of that in 2010. That was about the time frame. 2011, 12, there was almost a double dip recession before banks really started ramping up the lending. Interest rates, rock bottom, of course. Most of you know this. But that's where we're at, folks. We're in the biggest debt bubble of all time, enabled by the money that's just created at the click of a mouse. Banks can keep on loaning out money even though they don't have the actual money in their vaults, right? That's the key to understanding this whole thing. But take a look at some charts here, right? A lot of people think that banks are making it more difficult to get loans and they're tightening, right? They're making it more restrictive on the lending. That's not true. In fact, if you compare now to the financial crisis, very few banks are actually tightening, right? Let's pull up a chart here, and you can go to the Fed's own charts for this. This is Fred here, Federal Reserve Economic Data. And what do we see here? Let me get you a bigger chart here, the biggest one possible. And I think this is going to explain things really, really well for people that are really not understanding how people are still able to continue buying things, to go out to eat at fancy restaurants, to travel. Airports still packed with people, even though these debt levels are astronomical. Take a look at this right here. All right. In the dark shaded area, let's see here. Okay, financial crisis era right here. Let me scroll down a little bit so you can see the years on the bottom. Right, we see 2008 through middle of 2009. That was the downturn or the recession, right? Banks that tightened at that time jumped up to over 60%. And you could see the tightening stayed there for a while. What is this, about a year? Right, up here where the cursor is right now. You're seeing that. That was tightening. Over 60% of banks tightened their lending standards for credit cards for about a year, right? Fast forward to 2020, we saw a brief spike up to banks tightening over 60%, but that was quickly dropped. What happened to make banks no longer felt like they had to tighten? Well, guaranteed money, guaranteed keeping these banks operational, keeping them propped up, right? So then it dropped, and then it basically leveled out because those same banks that were tightening made lending looser, and we saw the reserve requirement hit zero for the banks. And even now, we jumped up almost to was almost 40% at one point, right? But now we're dropping again. The banks had started tightening, and we were on our way to a 2008 type of tightening situation for the banks, and that would have been the nail in the coffin, folks. Once banks tighten and once people can no longer spend borrowed money, this economy is done, right? This economy is basically running on consumer spending right now, government stimulus, government programs as well, but most of it's consumer spending enabled by banks loaning out money, allowing people to go deeper and deeper and deeper into debt, folks. This is the key, right? So even the tightening that we saw in 2020, that was very brief, and it came back down just after, what, a couple weeks. Back then, it was many, many months, and that was one of the things that made it such a severe economic downturn, right? People thought we would never get to the levels that we're at today for home prices, for just the levels of debt, the cost of living. People thought we would never see that again after the housing bubble slash great financial crisis of 2008, 9, 10, right? But here we are because of lack of regulation, right? People think that regulation got more strict or more, it got tougher. No, it's just the opposite. It got more easing, more restrictive, not just the low interest rates, but the way that banks are allowed to operate, right? So we did see this tighten about almost 40% of banks. Was it 38% of banks at the end of 2023 were tightening? But look what happened here going into 2024. Now it's dropped back down. Now we're down closer to looking at the chart here, I'd have to say about 26, 27% of banks are actually tightening. So for those of you that did see your credit limits drop on your credit card or you found it harder to get a loan, you may be in one of the 20 something percent of banks that are actually tightening. The other 70 something percent, close to 80%, are actually not tightening. They're making it easier to get a loan. Why would they be doing that right now in this environment where people are starting to get behind on their loans? Delinquencies are piling up everywhere you look, all types of loans. Why would they be doing that right now? Well, I think they have an incentive, so to speak, to keep this economy from imploding, right? No one wants this economy to implode on their watch. So of course they're going to probably talk to the banks, and if I could paraphrase, I would say something like this: Hey, you better keep this economy going. You're going to be blamed if the economy fails, and you're going to be blamed for all the job losses, for the economic fallout. So I think the banks were put in a spot where they have to keep loaning out money. And of course, the banks are probably not going to really argue because they know they're just going to get rescued in the end, anyways. Right? Certain banks. Now, here's the thing: the top five biggest banks operate about half of the market share in the banks. I've got another chart pulled up for you guys. It's out of Wallet Hub, right? Bring this one up here. And what do we see here? The top biggest banks take up about half of the market share for deposits, right? We've got Bank of America, or Chase first, 16%. Bank of America, just under 15%. Wells Fargo, and Citibank, number 4, and U.S. Bank, number 5. So top 5, close to half of the market share by deposits, right? So it only takes these 5 banks to run half the market. If those 5 banks don't loosen, or if they don't tighten, you're going to see a lot of money still loaned out, and you're going to see people continue on with the ability to spend money that they actually don't have. Now, on the other side of that, you have still an end game, right, or an end point, because even consumers that can borrow money, they always, not all of them are going to be able to continue to pay back this money, right? We see a lot of programs right now making it easier for people to pay back the money they owe. Look at the student loans right now. And I personally think something similar to that's going to come out in the mortgage market. I think there's going to be some sort of rescue, not just the ones that we're seeing now. We are seeing some now, by the way. We're seeing down payment assistance programs for new buyers. We're seeing holders of certain loans be able to redo their loans and cut their payments down. We're talking about VA loans and FHA loans. They have special programs right now for people that are struggling, right? So this could expand to all loans, all mortgages, and that's how they can keep this going. You see what I'm saying here? So there has to be a lot of different programs in place to keep this economy from imploding. Just like in 2020, what do we see? The moratoriums, the foreclosure prevention programs, all those things that stopped the economy from dropping, that actually took the economy and the markets higher with it, and the cost of living higher, right? Everything was inflationary versus deflationary, like we saw in 2008, 9, 10. The financial crisis, 2008, 9, 10, that was deflationary because the way the banks handled the situation. But now things are a lot different. Look at the chart we talked about with the tightening. Not many banks tightening right now, less than 30%. Back then it was very different. And we see a lot of the mega banks now got bigger, and they're running about half of the market share based on deposits, right? So there you go, folks. That is the key to understanding this whole thing. So how long can this go on? Well, the banks can basically stay um, propped up forever because of the money. The money can just be created and pumped into certain banks. Of course, the smaller, the regional banks, they will be allowed to fail. Let me shut something off over here real quick. But the bigger banks, they're not going to be allowed to fail. So it's going to be consolidation. Yes, you'll see bank failures, and you're going to see some panic evolve out of that. But it's not going to be enough panic to cut off the lending, in my opinion, right? So it's going to take something massive for that to happen. Um, and I wouldn't put all my eggs in one basket right now. That's why I always say right here, keep stacking, be ready for anything, be ready for more inflation in case we don't see a market breaking situation. Be ready for something to come in here that's so big that it even frightens the mega billionaires that run, for example, the stock market. We see 90% of stocks almost are owned by the top 10%. If something so big happens to where that top group, that top 10%, starts selling and hitting the panic button and selling, then you're going to see even the markets come down. Right now, we've never seen markets so detached from Main Street. You look at the stock markets, all the indices, not at all-time highs, but some of them very close still. And that's very surprising to a lot of people, but the disconnect has always been there between Main Street and Wall Street. When I say that, I'm talking about regular people that work 9 to 5, even people that are retired. Those are Main Street individuals. The big mega companies, they are Wall Street, the top 10%, the hedge funds, the billionaires, right? So when something so big happens, that's what will finally put the nail in the coffin for this economy. It's either that or the banks. The U.S. consumer, maybe that'll be first. Maybe finally millions of people will hit this brick wall, even with the banks trying to make it easier to borrow money, even with all these rescue programs coming out and assistance programs. Maybe that'll happen first, right? Nobody knows exactly. That's why you have to sit here, step back, analyze all the data, try to put everything together, connect the dots. It's not easy because there's so many moving parts to this economy. But here's something pretty interesting. Recent headline here. Stock market bulls face test as consumers start to show signs of stress, right? We talked about that in our last report, how many companies are reporting very weak demand out of consumers. In fact, a lot of these companies, including Starbucks, came out with very weak earnings, and they're pointing to a big slowdown in the way consumers are spending money. Something else I wanted to get into today here. People think I'm negative or doom and gloom, as some people might say down in comments. Take a look at this here. This is a recent survey. Shock survey reveals huge number of Americans expect to see another civil war within 5 years, folks. This is a very divided country right now, and people are divided for all the wrong reasons, right? For one thing, people are placed into different groups. Right? You've got to be left, you've got to be right, you've got to be pro this or pro that. Otherwise, you're labeled something bad if you're not. So people are very divided. They're put into different categories, and now the categories and the different labels that are given, they're fighting amongst each other. And instead of looking at the big picture, instead of seeing how everything is operating here, the way the money is created, the way it's loaned out, why the cost of living is so high. We also have a destruction in, guess there's the rhyme that goes with this. We have destruction of production. We have destruction of production. We still have jobs being outsourced. We have manufacturing facilities shutting down, cutting staff because of the slowdown in demand, for one, but there's several reasons behind that. Here's how Fortune put it here. The U.S. economy is headed for a hard landing, and Fed rate cuts won't be enough to rescue it. That's Citibank. And that's one of the top 5 banks. I believe they were 4th on the list of the biggest banks, the biggest top 5 banks. So when Citi's saying this, and Citi is one of the big banks that are going to be propped up no matter what. So when they're saying the U.S. economy is headed for a hard landing, you might want to start making maybe a little bit of preparations here for something to go down. Now, people say, oh, it's never going to happen. It's never going to go down. Folks, it's already happening. If you look at the levels of debt, if you look at the defaults right now, or the delinquencies rather, things are happening. It just hasn't hit a wall yet. And that's because the banks, people can still borrow money. When you go out and go shopping and go places, things are still going to look normal. But behind all that, behind the facade of people happily spending money, is where the money's coming from. It's not saved money, right? It's not saved money. The savings rate is, again, near an all-time low. It dropped again last month. Remember, it dropped in January, February, dropped in March, and it dropped in April. It's continuing to decline. So we're going to need another big round of stimulus checks or something to bring people back from the financial edge, because people are uh, either on or approaching the financial edge. And you can say, well, the banks can just keep increasing the credit ceilings forever. Well, not when delinquencies start spiking, because even with the high credit limit, if you can't make your minimum payment, you're pretty much done. And a lot of people are going to start drastically pulling back on spending. We're already seeing it. What do we see? 500,000 people cut their cable. Was it Comcast? We just talked about a couple reports ago. In 3 months, half 500,000 people, yeah, cut their cable. I'm trying to remember. I could look it up, but I'm pretty close. Pretty close to 500,000 people cut their cable. Right? People are cutting back to make ends meet, to get by, because this cost of living is making it very, very difficult for people. And even the months where the jobs numbers look good, we've had a couple months where they look at, actually last month was a disaster, but even the months where they were higher than expected, what kind of jobs are these? Are these part-time jobs? Are these jobs that are actually going to help people um, keep their head above water with this current inflationary slash massive cost of living crisis that's happening right now? When you look at how much rents are, when you look at home prices, the cost of living, everything else that goes along with those things, insurance, car registration fees. I recently paid 400 and almost $450 to register, a 1 year registration for my 2019 vehicle here in California, right? 400 something dollars, almost 450, just to register a vehicle for 1 year, folks. A lot of people aren't going to be able to keep up with this. I don't know if I'll be able to keep up with it here. By the way, some people were asking, what's my investment strategy and stuff like that. If you stay tuned, I talk about investments here quite often. I've probably told you about five, maybe six stocks just over the past 6 months that I'm invested in. Some I've done pretty well in, actually. But my position right now is much smaller than I've been over the past few years, because I see the risks out there. It's 2024. That thing happens in November. That happens every 4 years, which a lot of times can create chaos. Look at 2020. Cities Hollenburst bucks crowd and sees big rate cuts and hard landing. This is another report about the city prediction. So something pretty drastic is going to have to happen to justify rate cuts, because remember, the Fed, they were looking for inflation to come down, and therefore they were going to do these, what, 3 or 4 rate cuts is what they had put out there or predicted at the beginning. But the inflation didn't come down, folks, so they had to back off of that. And with predictions like this, big rate cuts ahead, you have to ask yourself, what type of situation do they see popping up that's going to justify these rate cuts? All right, let's jump over to the housing market. Real estate, such an integral part of the economy. It's what started or triggered the 2007, 8, 9, 10 financial crisis. I should say 8, 9, 10, because 2007 was kind of still very inflationary, right? Out of Fast Company here, housing market inventory is shifting. Here's what the data shows, and there's some good visuals in here. I wanted to make sure that you are looking at this here. All right, so I hope you guys can see this. This gives us a line for each year, and we see currently April 2024. Looks like we're about 770,000 homes right now for sale, which is the inventory out of Realtor.com. And this is higher than 2020, 2021, 2022, and 2023. So the highest in 4 years. Now we're still below where we were pre-pandemic, as you can see up here, we went up to about what 1.3 million in 2017 and almost again in the summer of 2018. By the way, inventory peaks in mid to late summer. Then people start pulling their homes off of the market as everything slows down as we get into the fall and into the winter. So we're yet to see, what the peak inventory is going to be this year. Will we see a massive spike up to a million with so many people struggling to pay their bills, so many homeowners maybe rushing to put their homes on the market? With the types of things that we're seeing right now, I wouldn't be surprised to see the inventory spike up over to a million mid to late summer. So we have to keep a closer eye on this. We'll look at it every month, as always, but we're going to keep a closer eye on it in July, August, September to see where things are at. But it might become so obvious by then that everybody's going to know what's going on here, folks, right? So hope you guys enjoyed all the charts, the data today, the analyzing of the economy, where we're at, why we're here, where we're headed. Look for some sort of rug pull possibly to bring this whole thing down, because it's getting harder and harder and harder, more difficult for the powers that be to keep things propped up, right? Again, all the rescue programs out right now with the different types of loan assistance happening, and how much longer can they keep this thing swept under the rug, right? But we might see something. We might see some sort of rug pull. So whatever is swept under the rug is going to be revealed when we see a rug pull, and when we finally see this debt-based economic economy, this debt-based economy finally implode, right? And if that doesn't happen, it's going to be possibly even worse, because the inflationary side of things, if we don't see a rug pull with deflation, the inflationary side of things, excuse me, I hit my bumped my mic here. The inflationary scenario is much, much scarier, right? So either way, keep stacking, folks. Get ready. Eggs not all in one basket. Be ready for different ways that this thing could play out, right? Nobody knows exactly. Some people out there tell you exactly what's going to happen, but if you look at them, a lot of them have been wrong. The people that have said home prices are going to crash, I can pull up videos from 2020, 2021. They say this bubble's going to crash in a few months. Folks, they don't understand the basis of everything. And a lot of it's what we looked at today. It's the lending. It's the way money is it's the way money's created and handed out, folks. So stay tuned to this channel. Make sure you're still subscribed. We're going to get through this together. You're going to be way ahead of the financial curve here, folks. We're going to get through this together. We'll talk to you very soon. Keep stacking. Bye for now. Peace.